The Federal Reserve has went with this next move in its monetary policy in this fight against inflation, raising the federal funds rate by 25 basis points or 0.25%, bringing the federal funds rate from 4.75 to 5%, with a current projected terminal rate of 5.25%, indicating there may be another rate hike of 0.25% in their next meeting in May. The media has been covering almost every major asset sector on this topic, but the one going to be covered in this video. They've covered the real estate market. They've covered the commercial and residential versions of the real estate market. Crypto has been getting the spotlight. The stock market as a whole, individual sectors in the stock market has been getting, its attention. The bond market, it's just been all over the place. The one area that hasn't gotten much coverage at all, that is very important to millions of you out here in this country, is the 401k. Of course, the general stock market and bond market play a role in the 401k and the overall economy does, but there's been no direct conversation around the current economic circumstances and the Federal Reserve's decisions in your 401k for a while that I've run across in the media. So I want to cover it in this video. This is JP from Blueprint for Prosperity, getting out of the office for a few minutes and enjoying a beautiful day of spring here and helping you increase your net worth through relationship banking, the maximizing of your borrow capacity, proper use of life insurance, and ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So, with the latest update from yesterday's FOMC meeting with the Federal Reserve raising rates by 0.25%, the market had largely priced that move in. I recorded and shot a video yesterday that went over the meeting, the press conference, the market's reaction, so on and so forth. So check that video out. It kind of goes into some level of depth. I tried to keep it a little brief, but it breaks down a little bit. We're not going to do too much of that in this video unless it's in relation to the topic at hand, which is your 401k. So your 401k is largely, in most cases, going to be comprised of a target date fund. This target date fund is going to be in consideration of your expected retirement age, roughly, or retirement year. In some cases, or usually you get to pick that, but, depending on how you set it up and how much you're paying attention to it, you may not pay attention. But at the end of the day, your 401k is usually comprised of a target date fund. A target date fund is going to use some level of automation to basically select your investments based on your goals and your demographics. So your age and investment goals. Maybe you plug some numbers in and say what you're looking to have in retirement, whatever the case may be. And it kind of formulates an investment strategy and picks investments based on that information, that data, right? So that means if you are, hopefully the wind isn't affecting the sound too bad in this video, but that basically means if you are, further from your retirement age by a significant window of time, let's just say you're further from your retirement by 20 or 30 years, your investment portfolio is going to look significantly different than somebody who's within 5 or 10 years of their retirement years, right? So that basically means that the portfolio is going to bend and mold and reshape itself based on where you are, what's working and what's not working, ideally. So that means that right now, most of you, your 401ks are probably getting trashed because the bond and stock market, largely as a whole, are trash. They're basically a bloodbath at the moment. So with that being the case, that means if you are closer to your retirement years right now, let's just say within 3, 5, 7, arguably maybe even 10 years within your retirement years, intended retirement age, you could be a little wrecked and rattled at the moment because your 401k could be taking a beating. It may not have time to recover from, depending on where the economy is going and the stock market's going and the bond market's going in the next 3, 5, 7 years. If we're just in the early innings of a very rough bear market, then that means that the next 3, 5, or 7 years could be down years or just stagnant years. This is a little nerve-wracking for those of you who are close to retirement, because that basically means your 401k could be taking a dip that it won't have time to recover from, which could force you to have to work longer, or it could force you to have to retire at a deficit, from where you intended to retire from as far as your 401k is concerned. Genuinely hoping that your 401k isn't your only retirement vehicle. But for many of you in this country, and many of us, it is either the only or the biggest. So I've made a video not too long ago about your 401k and how to save it. And one of the biggest keys to that is a consistent rebalancing. The concept of rebalancing is adjusting the investment strategy, going in and whatever mobility you have or control you have, moving things around to, maybe, and this could be an example of like reducing the amount of stocks you own and increasing the amount of bonds, or vice versa, increasing the stock holdings, reducing bonds. Generally speaking, bonds are the more conservative, aggressive portfolio. Stocks are considered aggressive. So you can go in, depending on where you are in your retirement window and where your 401k's performance is, and adjust that along the way. You typically can't go in and pick individual stocks and bonds. It doesn't give you that level of control, unfortunately. But you can kind of control, typically you can work with the custodian to control, your allocation, your asset allocation. You can have a little influence on how much international versus domestic exposure you have and things of that nature. Rebalancing is really important right now. In the video that I shot, I want you to go back and catch it, of course. But I generally was encouraging individuals to rebalance every 3 months or so. And if you're familiar with how this normally goes, that sounds extreme, because typically rebalancing is an annual, maybe semi-annual recommendation. I was making a suggestion, because this is not financial advice, though I'm a licensed professional. I am not your licensed professional specifically. But generally my suggestion has been to look at it every 3 months and make adjustments, because the market and the economy have been shifting that fast. So hopefully, if you are actively at your job and your 401k is actively at your job right now, you look at rebalancing. And honestly, it's hard to do right now because the bond and stock market are unattractive. But you can do a little research or get another financial professional you have access to help you look at it and find out where you can stem the bleeding if you are taking losses. And maybe that might be reducing your bond exposure. Maybe it's reducing domestic stock exposure. Maybe it's increasing longer term or shorter term bond exposure. You need to rebalance, and you need to do something, is the moral of this story. If you have a 401k and you're not actively at that employer, then if you're not aware, you need to go back and get that 401k. If you don't know if that's a thing, it's a thing. You need to go back and get that 401k, because it's sitting somewhere doing absolutely nothing. You reach out to the custodian that was holding that is holding that 401k that was tied to that employer, and you communicate with them about doing what's called a rollover to some other IRA or investment account you have set up, likely at your financial institution. This will actually allow you more control of this asset. If that's the case, that's going to be the gift. You will have the opportunity to roll it over into an investment where you have a lot more decision-making capability, because it's going to go into a brokerage that you can pick to trade options. You can pick index funds, and all kind of different things you can do with that money once it's rolled over. It just has to go into another investment directly to avoid tax penalties. Speak with your CPA on that. So the overall broader implications of the federal rate hike right now is keeping the market in, and of course the sentiment of the Federal Reserve and the government too, not just the rate hike, because the Federal Reserve has pivoted in a very short amount of time from bluntly hawkish, to neutral or split down the middle. I used the word yesterday of flexible, because they went from just 2 or 3 weeks prior, especially right before the banking crisis situation, they had to, Chairman Jerome Powell had to sit in front of Congress and testify, on his role and what he's doing to basically um, give his analysis on what their decision making and to the American people. That's what that's basically about, right? So to speed this up, he basically was speaking, saying that inflation is still a dangerous fight, job market's still hot, money's still flowing, like crazy, and they're not quite getting the results at the pace they want to get them with inflation. So they need to be more aggressive. This was maybe 1 to 2 weeks before this banking situation took place. That banking situation takes place due to the fact that the Federal Reserve has been raising rates aggressively and the bond market's a mess, and banks couldn't liquidate their bonds to get the money to depositors who were asking for their money back. Hopefully you followed that chain of events. Because of this reason, the Federal Reserve started to dial back its conversation yesterday in its press conference in the FOMC meeting. For good reason. They needed to continue raising rates to not startle the market and to keep conviction on their fight against inflation. They didn't have much of a choice. That having been said, it's evident that there's serious problems in our banking system, particularly from our understanding, there's serious problems with medium and smaller banks, which make up a very significant portion of our economy. It's a big deal. So with that being the case, the Fed is kind of stuck between a balancing act of a really, fragile banking system in some areas, a fragile economy in some ways, and still burning hot inflation that's starting to get stubborn. And the fight against those two are opposing strategies. You would need to stimulate the economy and put liquidity into the system and lower rates in order to save the banking industry or give them some reprieve and to help stimulate the economy in the ways it might need to be stimulated. You need to take money out of the system, increase interest rates, and compress the economy, tighten lending in order to fight inflation. And both are very, very bad places to be in. A crashing economy, fragile banking system, and inflation. Many economists and analysts would argue that inflation is the most dangerous. The Federal Reserve clearly has agreed on that to this point, and they've made their decision around it. That having been said, where does that leave the economy right now, with their most recent rate hike? It leaves the economy stuck in limbo because the banking crisis is very real. The Federal Reserve is trying to see a silver lining out of it, saying that they hope that, or possibly anticipating, I'm not going to necessarily say hope, but it seems like they're hoping, anticipating tighter lending due to this banking situation because banks have to be more conservative to limit their exposure. And that tighter lending has the similar effect of interest rate hikes. It takes money out of the system, and that lack of liquidity slows down business growth, slows down consumer spending, which thus slows down inflation. So with all of that happening and coming into play, that basically means that your stock portfolio and your 401k are exposed in different ways. The bond market is still a mess because interest rates are raising, and that's usually inverse for bonds on average. The stock market is a mess because the companies that make up the stock market are dependent on liquidity in the system for their growth in many cases. The financial sector of the stock market in particular, when you think about banking, banks make the bulk of their money and their portfolio is largely made up of lending. So if they are in a situation where it's getting more expensive for them to borrow and pump money into the system and lend, and then you type that off with exposure, issues with exposure that could, also cause consumer confidence issues and depositor confidence issues, and also lead to some serious problems. That puts the entire stock market and bond market in a really dark place. Your 401k could be taking a beating right now, and the only way for you to do anything about it is to do a consistent rebalancing, work with a financial professional who is willing to take the time out to give you some guidance, and make the adjustments that you can make best on your knowledge and best of the knowledge of any financial professional who might be guiding you more personally. Because especially if you are retiring in less than 10 years because you might not have time to shake back with your 401k. If your retirement window is beyond 10 years, beyond 15 years, then you probably, if you believe in the long-term health of the U.S. economy, that is, then you're probably going to be fine. If the economy goes through a 2 to 4 year nasty period and starts to bull run again, 4 or 5 years from now, the last crisis we had financially, 2007, 2008, if you want to say 2007 was the beginning, 2008, then, we started to see a rebound around 2011, 2013, depending on what market of the investment market you want to go off of. And so that means that our down period at the time was, somewhere between 4 and 6 years. Could be shorter than that. Some stocks started to bounce back after 2009. But, we're in an economy now with technology that is allowing things to happen at an expedited rate. The Silicon Valley collapse taught us that where depositors were able to get their money out so much faster than they would have been 10 or 15 years ago. The economy is shifting so much faster because people have the ability to spend money, borrow money at an enormous rate. They have the ability to sell stocks and bonds and buy stocks and bonds at an enormous, at an incredible speed and veracity. And it's making the shifts in the economy come really fast. So that could mean that things could go bad fast and bounce back fast. They could go bad fast in a multitude of ways and stay ugly longer. But for you, you have to be cognizant of your 401k and treat it like a baby right now. You have to do consistent rebalancing. You have to do your best to get financially literate yourself and work with financial professionals to make healthy decisions around your 401k. Because depending on your window of time, depending on where your portfolio is sitting, the losses it's already taken, it could be terminal. It really could be terminal. You can take losses that you can't get back. And that sucks. Because if you are that close to retirement, then that's a likelihood your 401k has been something you've been diligent and responsible with for decades. And it's terrible to think that in a matter of a handful of months or a year or two, that all of that, or half of that, or 30 or 40 or 50% of that could be wiped away. But it's the reality. And I wanted to bring this video because you need to put this picture together and understand that it's no time to sit on the sidelines when it comes to your investments. You have to take responsibility. And you have to get educated, and you have to work with reliable financial professionals to guide you through this process. So I hope this information was valuable for you and right on time for some of you. I know it probably was. And I appreciated bringing it to you. I'm going to continue to drop fresh live content around this as I drop my regular content as well around overall financial education. Man, I wish everybody out there luck. I wish y'all all luck in y'all journey financially in this process, because we're in really uncharted waters and even our leadership isn't sure what to do. So, take responsibility, put in the work that needs to be, put in, study, continue to watch videos like this, continue to do all of your research, make the necessary adjustments, pivot as needed, stay strong, stay strong. As always, I want y'all to stay focused, stay in motion. I'll see y'all soon.